I hope you are doing great. I welcome you back to our class where we are continuing with advanced financial reporting, and that is chapter 1. We are in the process of winding up chapter 1. Now, I welcome you if you have joined us, and I wish you are following what we are doing as far as financial reporting advanced level is concerned. Just as a reminder for the new students who are joining us and those who are following us, I just want to remind you that we are doing advanced financial reporting and analysis, that is a CPA, and we are trying to wind up chapter 1, which is about accounting for assets and liabilities. The topics that you find there include leases, which we did. That is operating lease and finance lease. We have covered that. Deferred taxes with group aspects or including group aspects. We have covered that. Employee benefits. That is what we have just covered. But we are taking one extra example so that we can move to share-based payments. So let's take an example here. And I want to remind you that be following from our previous lessons. If you are just joining us, you'll be able to get whatever we have done in our YouTube account or channel. So just be following up. You can subscribe in our YouTube so that you may be following what we are doing. So we are taking an example here, illustration about employee benefits, and that is IAS 19. So once you have completed this question, which appears on the board, which is about employee benefits, we'll take share-based payments, then impairment of assets, as well as financial assets and financial liabilities, and that will be the end of chapter 1. So we will move to group accounts. Right, so let's look at that particular question, and I just want to remind you that the theory part of this particular chapter, the theory part of this chapter, you find it in our previous lesson. If you were not present, the previous lesson, just go to the YouTube and then you can get illustration concerning this type of questions relating to IAS 19 employee benefits. We are taking a question from December 2017, question 2C. December 2017, question 2C. Now here, I just want to remind you that the format for defined plan asset, you start with fair value of plan assets. You deal with defined plan assets separately. Once you are through with that, you take the defined plan liability separately. That's important. So this is not one continuous solution, but note that this illustration comprises of two things or two items up to here. If you can see that line, if you're able to see that line, then it means from here up to here, that's the calculation for defined plan asset. And then from here up to here, that explains you about defined plan liability. Now note that as we discussed last lesson, the format is just the same. I told you to master the format. The format don't change. The format do not change. That is the items appearing here. So once you are taking the examination, start by putting those items here, and then all the numbers will be provided. The reason as to why I've decided to take this question is simply because the last question, which we did, and you have it in the YouTube is that I told you that you can have a question from employee benefits whereby you are given several years. The previous question that we did, we were only dealing with 1 year. Now, what do I mean? I mean, the last question that we did, you were only given 1 year for defined plan asset and for defined plan liability, only that. So I told you last lesson that if you are given a question from employee benefits, then you are given several years, like in our case here, the opening balances will be given most of the times. The opening balance, like this one, will be given, and the closing balance will also be given. Now, you are given the first year, the second year, the third year, whichever number of years that you have been provided with. So usually, the closing balance here becomes the opening balance, and the closing balance here becomes your opening balance. These items will remain the same, and the numbers will be provided. So that was important note number one. That is, the example will provide you with fair value of plan assets by the start and fair value of plan assets by the end. You know the items to be entered and how to calculate the actual gain or loss, and we say that is always the balancing figure, comparing the carrying amount with the fair value of the plan assets by the end. So once you get the closing figure, which is always provided, it becomes your opening balance next year, and then you continue the process that way. The same applies to defined plan liability. We know the items to appear here. Present value of plan obligation by the start will be provided. We know what should be entered. We say these are expenses, current service cost, past service cost, interest cost. Benefits paid is said. It is always the same. Like, for example, you can see here, benefits paid was 15. It is the same 15 which was deducted here. Now, once you do that, you get the carrying amount. You work out from here up to here, you get the carrying amount. Compare with the closing figure there. Now, again, we said that if you are dealing with the asset, like for example here, fair value of plan asset, we entered contribution to the plan. Return on plan asset, we entered. Remember these rates will be given, like here. You are given 12% times 10, 100, you get 12 as the return on plan asset. With less benefits paid, you are left with 106 if you work out this part. This 106 is a carrying amount. You are supposed to compare with the fair value of plan assets by the end. This is always given. So the balancing figure here, you are the one to work it out as either actual gain or loss. If you are dealing with an asset and there is an increase in asset, then that is actual gain. If the asset reduces, then that is actual loss. For example here, your carrying amount after working out these numbers, you got 106, you compared with 96. So from 106 to 96, there is reduction by 10. That is an asset reducing. Whenever an asset reduces, then that is actual loss. If it is an increase, then you could have said actual gain. It is the opposite of defined plan liability. We know how to bring down the opening balance, it will be provided. We know what should be entered, and we less the benefits paid. We get the carrying amount. The closing balances will be given. Compare your carrying amount with the closing balances. If that liability, remember this is defined plan liability, if it increases, if a liability increases, then that is actual loss. If a liability reduces, then that is actual gain. Continue the process up to here. The closing balance becomes the opening balance here, and then you continue the same process. So let's revisit this question as it appears there. And I think I told you you should have all these past papers. Make sure you have all these past papers with you. Go to the KASNEB app. KASNEB means Kenya Accountants and Secretaries National Examination Board. You have those papers. Again, maybe you do not have those papers. Then I told you that I have a responsibility to present that information to you. Now let me project that. If you do not have those papers, you can check the question we are doing is that question there is 2B. Are you able to see that? Now check what we are told there. The following information was extracted from the books of Comfort Retirement Benefits Scheme for the year ended that 1st October 2016 and 20 and that 1st October 2017. You can see discount rate on 1st November 10% and 8%. Then expected rate of return on plan assets 1st November 2016 is 12%, 2017 is 10%. Average remaining service life in years, 10 years, 10 years. Then fair value of plan assets 1st November 96 and 110. Present value of plan obligation 1st November 100, 125. Current service cost 810. Benefits paid 1512. Contribution to the scheme 911. Then past service cost 4, then 0. You have additional information. Now maybe you may need additional information. As at 1st November 2015, the present value of plan obligations and the fair value of plan assets were both shillings 100 million. Assume all transactions occurred at the end of the year. Was that one well presented? Was it legible? That one there. You can get that information there, including what is required. The question is there. The question is there. Now you can see from the board, if I was to illustrate from the board, you are told for each of the years entered that 1st October 2016 and that 1st October 2017, determine the actuarial gains or losses. So what we are supposed to do in that case is that, because you know the format that you follow, I believe you have no problem with that. And you start with defined plan asset. You start with year 2016, so that you finish up with 2016, you go to 2017. Fair value of plan asset brought forward. The starting balance. And because this is 2016, we should be given the balances in 2015, obviously. So the balances, we are told additional information number 1. As at 1st November 2015, the present value of plan obligations and the fair value of plan assets were both shillings 100. What does that one mean? As at 1st November 2015, the present value of plan obligation and the fair value of plan assets were both shillings 100 million. So the plan asset, it means the plan asset was 100 by the start. The plan asset is 100 and also the obligation is is 100. That is what they mean. They have given you the opening balance, which is coming from 2015. Remember, this is for the year 2016 and 2017. So the closing balances from the previous year, you are told fair value of plan asset was 100. And also, for the plan obligation was 100. That is additional information number one. I present that one to you so that you understand what you're doing. Additional information number one is that 1st November 2015, you can read from there. Additional information number one. That is what we mean. Additional information number one. So additional information number one, you have been told that the opening, I repeat it for you, is at 1st November 2015, the present value of plan obligations and the fair value of plan assets were both shillings 100. So the opening balances have been provided for both the obligation means liability, for both obligation as well as for the asset. Okay, we move away from there. You are told that now we go back now to the information that has been given. You are told that, okay, let's work out on the plan asset. We are supposed to earn contribution to the plan which has been given. Contribution to the plan has been given as 9 for this particular year. We earn contribution, whatever increases that particular asset. Contribution is 9. You want to see that? Contribution is 9. Contribution is 9. You can see that contribution to the scheme. Second item from below was 9. You can see it up there. Contribution. Then the next thing is return on the plan asset. Return on the plan asset. 2016. You can see present value is a expected rate of return on plan assets. 1st November 2016 and 2017, you have 12% and 10%. 12% and 10%. So we said that you'll be given certain rates there, which you use to calculate the return on the plan asset. And from that question, you can see expected rate of return on plan assets. For 2016, you are given 12%. 12% for 2016, 10% for 2017. So return on plan asset, you take 12% times 100. We said you multiply by the opening balance to show you the return on the plan asset. So 12% times 100 is 12. Is 12. Then we less what? Benefits paid. Benefits paid. Now benefits paid have been provided as 15. Benefits paid. You should be able to see that if you have the paper. Benefits paid. Benefits paid is a third item from below. Benefits paid, you can see that, was 15. The benefits paid was 15. Is here 15 we less than. Remember, you have to take 2016 first. Then once you have 16, that is it about that. The next thing is to get the carrying amount. So you take the fair value of plan assets by the start, plus contribution, return on plan assets you earned, you less benefits paid. Remember, this benefits paid will appear on both sides, including when you go to the present value of, that is when you go to the plan liability. So you let's start. 100 plus 9 plus 12 minus 15, you get 106. Now 106 compare with the fair value of plan asset by the end. I've told you most of the times the closing balance will be given. So has that one been given? Fair value of plan assets by the end. Obviously, it has been given. And that is 96. It has been provided at 96. You can see fair value of plan assets 1st November 2016, 96. 96. You are able to see that 96 there. So that is the value by the end. So this is always given. So you compare the carrying amount which you have calculated with the fair value of plan asset by the end, which has been given at what? 96. So your carrying amount is 106, but your closing value is 96. So this asset has reduced. It has reduced by 10. The difference between 106 and 96 is 10. So this 10, because it is an asset which is reducing, becomes your actuarial loss. So I told you that this part, you are the one to fill that part as a balancing figure. So that is your actuarial loss in that case. This one has been given. Now you are through with 2016 defined plan asset. So what you do is that this becomes the closing balance here for 2016 becomes your opening balance. And then you repeat the same process. So you realize that the contribution to the plan has been given, return on plan asset, because you are given for 2016 12%, and 2017 10%. You take 10% times 96 times the opening balance, you get 9.6. Benefits paid will be provided, and then you work out that. Now let's see what we're saying. So I believe you understand that 96, this 96 is a closing balance for the year 2016. We open with it there. Contribution to the plan has it been provided at 11. Contribution to the plan 2017. Contribution to the scheme, you can see 9 and 11. Contribution to the scheme has been given at 11. That is the year 2017. Contribution to the plan. Return on asset, you are given 12% for 2016 and 10% for 2017. So where is that coming from? The 10, you understand where it is coming from? Right. Check that. Expected rate of return on plan assets 1st November, 12% and 10. The second items, 12% and 10. So 12% is for 2016, which you used here. 12% times opening balance. Now 10% now times 96. You get 9.6. Then benefits paid. Benefits paid. Are you able to see benefits paid? At 12, the year 2017. You must have seen that. Benefits paid. Benefits paid. It appears there. Benefits paid. You should be able to see that. Benefits paid. Benefits paid is there at 12. So, once you have done that, you just take 96 is the fair value of plan asset, which is the opening balance from previous year. We earned contribution to the plan, 11. Return on plan asset, we took 10% times 96. You got 9.6. Less benefits paid, 12. If you work out all that, you get 104.6, and that is your carrying amount, 104.6. Then once you have done that, you should have fair value of plan assets by the end, which should be given so that you may compare your carrying amount with the closing figure. So where has that been provided? The 110. Well, that one, you find it here. The year 2017. Where has the closing figure been provided? 110. Can you see 110 there? Present value of plan, fair value of plan assets, 1st November, 110. Fair value of plan assets, 1st November, 2017, 110. So that is the closing balance. That should be the closing balance, which is this one. So what you do is that you compare these two figures, the carrying amount, the 104.6, which you have calculated up there, this one, compare with 110, which has been given. This is an asset, and this asset has increased from 104.6 up to 110. So when an asset increases, then that is an actuarial gain. So there is an actuarial gain of 5.4. That is from 104.6 up to 110. So actuarial gain. So we are through with the defined plan asset. We are through with defined plan asset. Simple and straightforward. So up to that, you'll finish that. So you come to the defined plan liability. You do the same, only that here, the items which you earn here, they are to do with expenses. Here, there are no expenses. With a defined plan asset, you are dealing with contribution to the plan, return on plan asset, less benefits paid, you get carrying amount, then you compare with the closing figure to get either actuarial gain or actuarial loss. Liability, present value of plan obligation, opening balance. I told you where the 100 is coming from, and I told you that is what you find in additional information number 1. You are told, as at 1st November 2015, the present value of plan obligation and the fair value of plan assets were both shillings 100 million. So you have been given opening balances from 2015 for both plan assets as well as for plan obligation, the opening balances. That is additional information number 1. I've just shown you, but maybe you have forgotten. You need not worry. As at additional information number 1, as at 1st November 2015, the present value of the plan obligations and the fair value of the plan assets were both shillings 100 million. So that is a figure. So you're given the obligation, opening balances, as well as the asset. We usually earn the current service cost. Current service cost in the year 2016, remember you are dealing with the 2016, so that this closing balance here becomes the opening balance for 2017. Current service cost, you are given 8. Current service cost, the year 2016. Current service cost is 8. Current service cost is 8. So you have this current service cost is 8. Then Past service cost is 4. Past service cost is 4. Past service cost is 4. It has been provided. Past service cost is 4. You should see it down there. Past service cost, the last item. Past service cost is the last item there. Is 4 for the year 2016. And then interest cost, you have 10% and 8%. 10% and 8%. That is to do with the discount rate. The first items you see there. You see those items there. Discount rate on 1st November. 2016, we have 10%. 2017, 8%. The first items there. So for 2016 is 10%. So that helps us to calculate interest cost. So 10% of 8, not 8, 10% of 100, 10% of 100 is 10. The benefits paid is 100. I told you benefits paid will be the same for both the defined plan asset and for defined plan liability. So this 15 is the same as here, so you less. We need now to get to a carrying amount. So 100 plus 8 plus 4 plus 10 minus 15, you get 107. 107 you compare with 100. The present value of obligation by the end of 2016, you are given 100. Now, where has that one been provided? Present value of obligations, 1st November. These items here, the closing balances for that obligation. See there? Where my figure is. You can see where my figure is. Present value of plan obligations, 1st November. We have 100, and then 125 goes to 2017. So the closing balances, as I told you, they will always be given or presented. So we have present value of plan obligation by the end is 100. So you compare 107, because you said 100 plus 8 plus 4 plus 10 minus 15, you get 107. You are given the closing balances for the present value of plan obligation from 107 to 100. That is so you can see this is a liability which is reducing. When a liability reduces, then that is an actuarial gain. It is the opposite of the asset. This is a liability which has reduced. So we are gaining. That is an actuarial gain from 107 to 100. That's a reduction in liability. So that is actuarial gain of 7. We have the closing balance at 100. So this 100 now becomes your opening balance in the year 2017. Now I'll move faster here. Now you have understood. So if you look at your paper, you find current service cost for 2017 is 10. Past service cost, there is no past service cost. Interest cost, I've shown you where 10% is and where 8% is. So for 2017, take 8% times opening balance, which gives you 8. Then, benefits paid, if you look at 2017, it will be 12. It is the same as this. If you look at benefits paid for the defined plan asset is 12. So the benefits paid are always the same. For example, here you can see 15. Here it is 15. 12. So here should be 12. So once you have done that, the next thing is to calculate then carrying amount. So take the present value of plan obligation, starting balance. Remember this 100 is coming from the closing balance for 2016. 100, you plus 10, then you plus 8, you minus 12, you get 106. So 106 is the carrying amount compared with the closing balance or the present value of plan obligation by the end of the year, which is 125. Are you able to see 125? You should. You should be able to see 125. Now 125, you should be able to see it then. The present value of plan obligation, 1st November 2017, 125. The closing balances and opening balances most of the times are provided. Check where my figure is. Present value of plan obligations. 1st November, those are closing balances. 100 as well as 125. So 100 is for 2016, closing balance, and 125 for 2017. For 2017. So that is where 125 is coming from. So compare 106 with 125. So this is a liability which has increased from 106 to 125. When a liability increases, that is a not deferred. Not deferred. We are not doing income taxes. We are not doing deferred taxes. But it is actuarial loss. When a liability increases, then that is an actuarial loss. So from 106 to 125. So we have 19 here. So that is the defined plan liability, supposed to be presented that way. I believe this part, we do not have much challenges with that. But let's see what the examiner was asking us. For each of the years entered at 1st October 2016 and 2017, determine 1, the actuarial gains or losses. So we have done that. Actuarial gains, one is 10, 5.4, the other is 7, and the other is 19. So we have done that. Now the other question they are asking, the net pension cost to be charged in the income statement for each of the 2 years. Roman number 2. You can read for yourself. You do not have the paper. What are they asking? The net, Roman number 2, the net pension cost to be charged in the income statement for each of the 2 years. That is what they're asking. The question is still there. You can just look at the question again. If you are able to see the question. But one number, from number 2. So what you do is that the net pension cost to be charged in the income statement for each of the 2 years. So what you do is that net pension cost, what income do we have? We have 2 years. The incomes, because you need incomes minus what? Expenses. You have a column for items, and then 2016 and 2017. Then, return on plan asset. Now, this 12 here, this is an income, because it is interest given there times opening balance. 12, you find it here. It is an income in 2016. Then 9.6 is an income in the year 2017. So those are our incomes. Return on plan asset, 12 and 9.6. Then we less expenses. Expenses that we have, they are coming from the defined plan liability. That is current service cost, past service cost, and interest cost. So the two, if you look at 2016, our return on plan asset is 12. So for 2016, you take 12 minus what? Current service cost of 8. We also minus what? 4, which is past service cost. We also minus what? Interest cost. Interest cost of 10. That's 10 there. So the final answer now is the net pension cost. So what you do, for 2016, you take 12 12 minus 8 minus 4 minus 10. You get the answer. That is for 2016. For 2017, you take 9.6, then you minus what? Current service cost. You minus 10. You also minus, so there was no past service cost. You minus 8. You minus 8 to get 8.4. To get 8.4. So that is how you get the net pension cost simply for each year. If it is 2016, it means 12 minus 8 minus 10, then 8 minus, that is, we have said 12, because that is the return on plan asset, minus 8 minus 4, then minus 10. Then for 2017, what will be the net pension cost for 2017? Return on plan asset is 9.6 minus 10, which is a current service cost for 2017. You minus 10. You also minus 8. And you get the net pension cost. Now the other item that the other question I think you have told the net pension cost to be charged in the income statement. You've done that. Then number 3, balances to be reflected in the statement of financial position as at the end of each year. You can as well see that. Question. Number 3, you can check number 3, what they are asking. So for number 3, is balances to be reflected in the statement of financial position as at the end of each year. Now we need defined plan asset. We are saying by the end of the year. So if you have 3 columns, one for the particulars, the other for 2016, the other for 2017. So defined plan assets by the end of the year, you just pick this. We prepare statement of financial position when? By the end of the year. So by the end of the year, defined plan assets for 2016, you put 96. For 2017, 110. Then actuarial changes. With the last question, the question that we did last lesson, I showed you how to establish the figures to be taken to the comprehensive income and equity. So here, what you do, you take the actuarial changes. The actuarial changes should go to the statement of financial position. So you can see the year 2016, we took 10 here. You can see actuarial gain. It was this gain or loss. It is an asset which decreased from 106 to 96. So actuarial loss, you compare with what? You aggregate with actuarial gain on the defined plan liability. You are comparing this. You are adding them. Actuarial gain or loss for the liability and actuarial gain or loss for the asset. In this case, you are saying negative 10, you plus 7, you get negative 3. So that figure goes to the statement of financial position, actuarial changes. For 2017, we do the same. You take actuarial gain or loss. Now here, this was an increase in assets from 104.6 to 110, so 5.4. Then you get actual gain or loss for the obligation. We got 19, so you are taking 5.4 minus 19, and we got 13.6. So those are the assets which you have. And lastly, defined plan liabilities by the end of the year. You just pick them directly. Present value of plan obligations by the end of the year, 100 and 125. You just put them there. And that is the end of that. But I don't think whether you are able to see this part, net pension cost and the statement of financial position. Let me adjust your camera a little bit. it can, even to help you. I'm sure you are able to see that. I'm very sure you are able to see that. I'm sure you are able to. So you can see what I have tried to do here. You can check that. Check what I have done. If you are able to see what I have done here, net pension cost, because this is a cost, I have just three columns, one for my particulars, another one for 2016, another one for 2017. So, net pension cost, I look at what is my income and what are my expenses. What is my income as far as all these workings are concerned? My income is return that I got on the plan asset. That return from the plan asset, that is my income. It's like interest on those assets. It's like interest coming on certain investments. Now, if I take, I'm given return on plan assets for 2016 at 12% and for 2017 at 10%. So what is my return for 2016? 12% times opening balance, I got 12. So that is my income. So when calculating net pension cost, I'll take my income at 12, return on plan asset for the year 2016, which is here. Then I less any expenses. Expenses originate from defined plan asset. And what are they? They can be current service cost, past service cost, interest cost. Benefit paid is not an expense. You can see it is being offset by the same item from the defined plan asset. It is offset from there. So basically, you can see I took my return on plan asset at 12, then less current service cost for 2016, which is 8. Then I also less past service cost, which is 4. I also less interest cost, which is 10. Then you are left with 10. Ignore the sign because it is a cost by the end of the day. So you ignore the sign. So that is for 2016. When you go to 2017, you look at the return on plan asset for 2017, which is 10% times opening balance, which is 9.6. 9.6, we are looking at expenses now from the defined plan asset. Expenses are here. Current service cost, we have 10. So we are lessing 10. There is no past service cost, but we have interest cost, which is 8. And then you are left with 8.4. That is the net pension cost. I think now you are able to understand what I have done here. And then that is the net pension cost. The other is statement of financial position. We prepare statement of financial position when? By the end of the year. So I'll be looking at my closing balances by the end of the year. So statement of financial position by the end of 2016 and by the end of 2017. Defined plan asset, we have taken fair value of the plan assets by the end. 96 and 110. My 960 is here and my 110 is there. Then actuarial changes. Actuarial changes have to go to the statement of financial position. So how have we arrived at that? The actuarial changes, you take the actuarial changes either loss or gain in the defined plan asset, that was your balancing figure, you aggregate with the actuarial gain or loss in the defined plan liability, those two numbers or those two figures. So here you are just taking actuarial gain or loss, which was this figure, 10, it was a negative. Because the asset reduced from 106 to 96, that was 10. So you're taking this 10, and then you get the defined plan liability item, which is here, this part here, actuarial gain or loss, whereby you got, I think it was 7. Yeah, it was 7. So you're taking 10, negative 10, plus 7. negative 10 plus 7, which is minus 3 and negative 3. The same applies to 2017. Look at actual gain or loss in the year 2017 was plus 5.4. This was an asset, the carrying amount which you calculated from here, 104.6, it increased to 110. So that means from 104.6 up to 110, increased by plus 5.4. You compare with actual gain or loss on the defined plan liability, which is 106. You are comparing with not 106, negative 19. So aggregate 5.4 and negative 19, we got negative 13.6. Then liability. Liability. Remember the statement of financial position as assets, liabilities, and equity. But I told you here, we are not interested in equity. Defined plan liability by the end of the year is 100 for 2016, it is 100 there, and 125, which is there. They cannot balance because these are an extract. These are extracts. So basically, that is how we should have attempted that particular question. So this was a continuation of what we did the previous lesson, because we are to conclude this particular topic today, which is about employee benefits IAS 19. So we have done the theories, the previous classes, we have done some other examples, and now we wanted to conclude this. The reason as to why I have concluded with this example is because the previous examples that we did, we were only considering 1 year. But I told you that you'll find some questions where the examiner gives you more than 1 year. So the only thing that you should know is that the closing, remember that these are two sort of accounts, one for defined plan asset up to here, and then the other for defined plan liability. Work on them separately. So work out all these parts, this closing balance becomes your opening balance for next year. Even if there was 2018 here, you could have taken 110 as your opening balance in there, then all the others will be given, including the return on plan asset. You just multiply these percentages by the opening balance, and then you get maybe the fair value of the plan asset by the end of the year, compare the carrying amount with the closing balances to get your actual gain or loss. And the process continues. The same will apply to defined plan liability. The present value of plan obligation, opening balance will be provided. All these ones, I showed you how they appear. Then the balancing figure becomes your actual gain or loss. Simple as that. So I think that's a comprehensive discussion concerning employee benefits IAS 19. This is advanced financial reporting, revising on December 2017 question 2C. Now that is enough for that, because we want to finish up chapter 1 this week, and then we move to group accounts. Just as a reminder, chapter 1 is about accounting for assets and liabilities, whereby you should know leases, including sale and leaseback, and dealers in leased assets. Now that is something that we have done, and we have covered that. So operating lease, finance lease, we have covered those areas comprehensively in class, and also we have uploaded some classes on YouTube. You can just get it from there. You can get us from there. That is Fatima Institute. Leases are there. That is IFRS 16 and IAS 17. Deferred taxes, the same. That is IAS 12. We have covered that comprehensively. Employee benefits, we have also covered that, but we just wanted to include this question because it has more than 1 year, so that you understand how to go about it, as we have done here, as we have demonstrated here. Now we are moving to share-based payments now, and after share-based payments, the last thing will be impairment of assets and also a bit of financial assets and financial liabilities. So that is what we expect in chapter 1. So in chapter 1, we have two more things to do. That is, we need only two lessons. That is share-based payments and impairment of assets, as well as financial assets and financial liabilities. So that is that. I think that's enough discussion. That's comprehensive. I told you that you just be part of us. You compare what we are doing on our side with what you are doing elsewhere. Maybe you are in a different school, or you are studying for yourself, or you just want general knowledge concerning financial reporting. I request you subscribe. Uh, you subscribe so that whenever we upload a class, or when we start revising, whenever we revise a question, you are able to get that notification so that you compare what you know with whatever we are doing here. So like our video, you make a comment, and then we'll be able to help one another. I told you the other time that we have a lot of information elsewhere. Sources of information are everywhere. So you as the consumer, you are the biggest beneficiary. You can compare different uh, tutorials from different people, from different sources, and then you can make your own decision after making all these comparisons from different sources. So let's meet again, and this is Fatima Institute Center for CIFA Studies. Thank you.